Meantime, former President Donald Trump's tax cuts significantly changed corporate tax rules. And unlike individual tax provisions, most corporate tax changes are permanent. But President Biden's proposed raising the corporate tax rate if he is reelected, bringing new debate to the state of corporate tax codes and where things stand. Joining us right now is American Action Forum President Douglas Holtz-Eakin. He's also the former director of the CBO and a Harvard Kennedy School professor. And Jason Furman, who is the former chairman of the Council of Economic Advisors. Good morning to both of you. Let's start with you, Doug. If, in fact, former President Trump wins again and were to try to keep these tax cuts in place, which is what I imagine you want to happen, is there a pay-for in your mind?
Well, I think the key here is to look at 2025 as an exercise in tax reform. And in tax reform, the basic goal is to keep rates as low as possible by broadening the base. And so in 2017, there was about $1 trillion worth of base broadening on the corporate side that helped pay for the vast majority of the rate reduction. You could go back and do more of that. There's no question about it. And the other thing to keep in mind, Andrew, is that if you decide that you want, as the president has proposed, to raise the corporate rate to 28%, you're reinstalling the real competitive disadvantage that our firms had. And the rate reduction to 21% has been an enormous success. Since we did that,
you think, though,
we haven't lost a headquarters.
I'm going to go to Jason. But there was two things real quick. Do you think the 28% is a real number or an anchoring device to the fact that actually it seemed like the corporate world was ready to accept effectively 25% last time?
Jason or me?
Oh, you're asking me. Sorry. Yeah, look, yes, the corporate world was, look, there was a number of good things in the TCJA. I'd like to see a number of it continue. But first of all, we shouldn't exaggerate the growth effects. There have been a number of studies. They've generally found it added less than 1/10 of 1 percentage point a year to the growth rate. Globally, you're actually not seeing tax rates falling. If anything, you're seeing corporate tax rates rising. And if we want to have tax reform, the first thing you have to start with in tax reform is what you want your revenue to be. And right now, there's a $4 trillion hole in what President Trump has proposed in terms of extending the tax cuts. And President Biden faces some real challenges, too, because he wants to extend them for everyone below 400,000. So either way, we are going to need more revenue. A higher corporate rate is one way we can do that.
Okay, so Jason, before I go back to Doug, how would you do it? You're king for the day. You can do it however you'd like to do it. I'm going to ask Doug the same question.
King for the day, I would do something, and might even get Doug to join me on this, which is the tax base matters almost as much as the rate. So I would make expensing permanent. I would disallow interest deductions. I might even do border adjustment on destination-based cash flow tax that Doug was a champion of. And once you do that, you can have a rate of 28%, but economically, on new investment, you have a much better incentive than what we have now. That expensing is very powerful. So I do that. You could raise revenue, increase economic growth. But absent that, if we need to raise the corporate rate, revenue is really important with our unsustainable deficit right now.
Doug?
So, Andrew, I think what Jason has pointed out is something that's really important that people should recognize. If you allow expensing of investment, expensing of R&D, then no matter how you choose to enhance the productivity of your company, whether it's equipment, new business models, raising the skills of your workers, you get an immediate deduction. The tax playing field is absolutely level. If you get rid of the interest deductibility, you now remove the distortion in how you finance those productivity-enhancing investments. That's what 2025 should be all about, getting a more efficient tax code. Second thing that I'd point out is everyone agrees that the corporate rate is not paid by corporations. And indeed, the president's proposal to raise the rate to 28% would impose a $500 billion tax on people making less than $300,000. That's a Treasury Department estimate. So it would violate his pledge to not tax people under $400,000. But if we're going to be realistic and we're going to tax those people, let's do it in a more efficient fashion that doesn't threaten international competitiveness. Let's go to the individual side, broaden the base there. That's what tax reform should be about, broadening the base of both the individual and the corporate side.